Good evening. This is breaking news, and just as expected, the US Central Bank has raised its target range for the federal funds rate by another 25 basis points. Of course, the chances of such a move by the market was seen at around 95%. So, to some extent, you could say that this hike was fully priced in. Of course, the language accompanying this decision is really what the street will be paying a fair amount of heed into. Into this decision, it was interesting to see what you were, what was going on as far as stocks and even treasuries were concerned, because you are seeing stocks, whether it's the Dow, the Nasdaq, or the S&P, inching higher. So are treasuries. Very surprisingly, you've seen a fair amount of resilience from emerging market currencies as well as stocks. The rupee for a third straight day ending at a fresh 16-month high. So clearly, at least this, 25 bips hike, as it were, more or less in the price. But I've got with me a special panel who are here to walk us through what this hike and, of course, the commentary from Janet Yellen in about half an hour from now will really mean for emerging markets. Joining in on the show this evening, EM Capital Management's Seth Freeman. Seth joins in from San Francisco. From London, we've got Berenberg Bank's Callum Pickering, who also joins in on a Skype connection. Jade Bryson of Wells Fargo Securities joins in on the phone line, and so does Hugh Johnson of Sir Hugh Albert Johnson. That is, gentlemen, all four of you, thank you so much for taking time out for us. Seth, to you first. I'm going to just wait for, the statement to sort of hit our screens. What we know so far, of course, that, the 25 basis point hike, more or less, was expected. What would you say is the possibility now of us seeing more than the 3 hikes that had been sort of predicted in December? Would you say that the case there has only gotten stronger?
I really do think we need to hear Chair Yellen's comments on this and get those. We're seeing some inflation. We're finally seeing some wage inflation, which has taken a very long time. And we're seeing sort of more or less, depending on which metric you like, a form of full employment. So these numbers from a data-based view are exactly what would support the Fed raising rates, assuming they are concerned about controlling or taming possible inflation. On the other hand, we're seeing some reports already about some very, very major expenses, such as rents in New York, San Francisco, beginning to decline. And we don't really know what's going to happen with oil prices.
Mm-hmm. Yeah, we will, of course, talk about that a little bit. I want to just, walk our viewers through all that we have from the statement so far. So like we said, the Fed has hiked interest rates by 25 basis points. The median Fed official forecast is now looking at 2 more rate hikes in 2017. So that's 1 done, 2 more to go. So that's 3 pretty much in line with what we heard the Fed tell us in December. They say that inflation is close to goal and, of course, refers to the target as symmetric, and Fed officials seeing 3 or more rate hikes in 2017. And that number has actually risen from 14 to 11. Callum, let me ask you, most expected the Fed to reiterate its commitment to a gradual rate hike, which of course they've done. Sure, the dot plot will tell us if this is a dovish hike or a hawkish hike. The median Fed fund rate projections for the short term, more or less the same, but now you've got 14 members versus the earlier 11 backing perhaps more than 3 rate hikes this year alone. What would you call it? Is this sort of a hawkish hike or a dovish hike?
I still think it's a dovish hike to think that even if the Fed hikes 2 or even 3 more times this year, that the real funds rate will still be negative when the economy is at full employment and growing at its potential rate. Of course, this is a dovish tightening of monetary policy. I'm just looking at the projections, and I don't really see major changes from the December projections. There's a small upward revision to 2018 to 2.1% from 2%, and a small downward revision in the Fed's long-run estimate of unemployment. So that we've got more FOMC members tending to.
Okay,
Well,
I think we've lost
even
that.
if the Fed's not out with it with its.
Okay, we'll just fix that and come right back. But Jay Bryson of Wells Fargo is also on the phone line with us. Jay, good morning to you. As Callum was pointing out, as far as the economic projections go, it's nothing that's sort of very bold. Do you suspect that in her press conference, Ms. Yellen, without being very specific, will convey her increased confidence in the economic outlook?
Well, yeah, I think so. I mean, I think they have generally been talking about that recently in a lot of their public sort of statements. Not only Mrs. Yellen, but some of the other Fed officials as well are getting increasingly more confident that, the economy clearly is sustainable and that they're going to continue to transition back to the 2% inflation rate and keep it there at a sustainable sort of rate. So, I think she'll have a fairly upbeat sort of assessment of the economy. But on the other hand, she may be talking about some potential downside risk, largely as it relates to politics, not necessarily here in the United States, but politics, particularly in Europe, with some elections coming up there, and some of the other things around the world. So, in general, I think she'll be fairly optimistic, but also, as all Fed officials are, also a note of caution there as well.
Right. Mr. Bryson, let's keep it with you. Now, the Fed, of course, for now, has sort of stuck to its forecast of 3 rate increases in 2017. But add to that say Trump's fiscal policies, about which we know very little. Many say that, some of these fiscal policies could perhaps quicken inflation far quicker than we expected, which in turn might then force the Fed to hike faster. Does that make sense to you?
It does make sense, but I think that's more of a 2018 phenomenon than it is a 2017 phenomenon. I mean, right now, the state of fiscal policy in the United States is somewhat on hold. The big thing that Congress is trying to work on is a repeal and replace of Obamacare, or the health system here in the United States. It's taking a lot longer than people thought, and so to the extent, and then the next thing that's going to be coming down the pike potentially could be corporate tax reform, but we're not, that's probably not going to happen until maybe later this year, and then maybe you get personal tax reform, but that's probably not a 2018 sort of phenomenon. And where's infrastructure in all this? A lot of people have been talking about a lot of infrastructure spending. That's really not going anywhere right now, and so the Fed's not going to get ahead of that. They're going to wait and see what happens in terms of the fiscal policy front. But, again, fiscal policy is moving slower right now than what a lot of people would have thought coming into the year.
Right. Hugh Johnson is with us as well. And Mr. Johnson, this question's for you. What can Trump's fiscal policies, about which such little is known, do you think to, the Fed's forecast? Because the Fed is, quite honestly, flying blind there.
Everybody's flying blind there. Nobody knows for sure not only what the fiscal policy is going to be in the form of tax cuts, spending increases, but most importantly, we don't know the timing. I mean, that's been mentioned by the other speakers, and they've talked about, at best, on corporate tax reform, late 2017. I would put it at 2018. And probably not until much later that we get tax reform for individuals. We also don't know at all about infrastructure spending, defense spending, and we don't know anything about the kind of offsets or the revenue raisers that'll keep the deficits somewhat subdued. I doubt that's coming, but keep deficits subdued in the face of big tax cuts. So there are lots of questions and no answers, as you suggested, and nobody has the so-called Trump bump or Trump fiscal policy or fiscal stimulus in their forecast for the economy and inflation. And even in the absence of having Trump's stimulus in their forecast, we're still talking about economic growth of somewhere between, say, 2.2 and 2.4 for 2017 and 2018, and importantly, an increase in the rate of inflation, not just to the 2% target, but slightly above the target. I actually have it even higher than that. So I think the Fed is on track for 3 increases and maybe 2 more in 2017, 3 increases in 2018, even in the absence of any fiscal stimulus. But you bet that's in the back of the minds of Fed officials, that they're thinking, what's going to happen if we do get a lot of stimulus, and then we might have a more significant challenge, and especially on the inflation side.
Okay, I just want to step back a little bit and quickly point out to our viewers that right after this decision and commentary, you've seen the Dow add about 100 points. The NASDAQ 100 has also hit a fresh record high. But Callum, here's what's a little strange and curious. You aren't seeing much with the dollar index. In fact, right now, it's trading in the red. Why is that, you think?
The reason the dollar hasn't gone up is because markets were expecting this. It didn't come as any surprise. I saw data this morning showed that there was a 95% probability that the Fed would hike today, according to market pricing. So I think we'll only see more upward pressure on the dollar this year related specifically to the Fed if suddenly markets think that, rather than going, say, twice in Q3 and Q4, the economy is doing sufficiently well and inflation is tracking above the 2% target, such the Fed may have to go more than that, say 3 or 4 times. What I find curious is there any more room left in the dollar for markets to start to price in the Trump stimulus? As your other callers have quite rightly suggested, we won't really see any effect from the fiscal programs until, say, late 2017 at the earliest. But if markets really decide that Trump really means this, and the rate of growth can accelerate from, say, 2% to 2.5% or up over the next few years, then we may see more upward pressure on the dollar towards the end of this year. But insofar as today, I think markets were expecting it, so we don't see any upward movement.
Well, Seth, let's tie this up with the India story. And what was very surprising is that usually currency as well as stock markets are on tenterhooks, at least in this part of the world, before we have an imminent and or impending Fed decision. But it's pretty heartening to see the kind of strength that you're seeing in the rupee. Do you think finally we've managed to sort of decouple ourselves? What's behind that, you think?
Well, this is one area that I look at closely, and I'm usually, pretty negative on the rupee when we see the Fed raising rates. But we've seen a strengthening of the rupee. The market's doing fantastic, in this period of time. And it even looks as though for some of the larger companies, earnings are looking pretty good. Perhaps, part of this is domestic sentiment driven. And also the recent elections with Modi's party doing well. So part of it's domestic, I think. On the other hand, I think that the country has also done a very good job kind of telling the India story. And if you look at money flows from the U.S. into India-focused mutual funds and ETFs, they've also taken in quite a lot of money. But even when FPIs are selling, we see the domestic investors staying in the market. In the old days, the domestic investors were running out first. So I think the dynamics have changed quite a bit.
So would you say that, if as sort of anticipated, we were to see 3 rate hikes from the Fed, Seth, in this year, one of which, of course, is already out of the way, do you think that India clearly will be able to sort of handle it and markets take it in their stride?
Yeah, I would say this is the first time in maybe 8 years.
Yes.
I can say that with interest rates rising, let's say 2 more times, that's probably baked in to many investors' notion about where the rupee should be. It's all going to rest really on the results of domestic policy, I think. But from a foreign investor standpoint, if the Fed stays at 2 more increases, I don't see that causing extra pressure on the rupee.
Callum, let's go back to the point you were making when we got disconnected. You know, the Fed, of course, for now, saying that it does see only 3 rate hikes in 2017. Do you suspect that anything could change that?
The unfortunate position that the Fed, like other central banks, finds itself in is, to use a slightly technical word, it's a Stackelberg follower in a game, so it has to take fiscal policy as given. Markets have raised their expectations for US growth over the next 2 years on the basis that Trump will introduce a fiscal stimulus. The Fed aren't in that position, which is why we don't see any revisions in either its near-term estimates for growth or its long-term estimates for growth. This puts the Fed in a tricky position. Should Trump introduce a fiscal stimulus which does substantially raise expectations for US growth and then deliver higher economic growth, it's likely that the Fed can easily fall behind the curve. At the moment, the Fed cannot preempt any of that policy coming in, so it really finds itself in a tricky situation with that.
Right. Jay Bryson, let me ask you this. You know, a lot of our panelists here do believe that the real impact of Trump's supposed fiscal policies or even tax cuts could take up until 2018 to show up. How would you then explain this euphoria that we've seen in the markets?
Well, I think it's partly a fiscal policy story, but I think it's also partly a deregulation story as well. And that's something that they can, deregulation doesn't necessarily have to have complete congressional approval. That can move a little bit faster. And so, even if you don't get a fiscal stimulus, even if you don't get, significant tax reform, you can still have this deregulation, and everything else equal, that would tend to lift GDP growth, at least for a period of time as the deregulation was going through. So I think it's partly based on some of that as well.
Mr. Johnson, would you say that maybe markets are running a little ahead of themselves? It's time we saw things cool off a little bit?
Yes, I would. You can do some number crunching to try to calculate just if there's a corporate tax reduction from 35% to 20%, what the impact that will have on S&P 500 operating earnings. And as I do the numbers, and everybody does them differently, I do the numbers, you get about a 10 to 12% increase in 2018 and 2019 S&P 500 operating earnings. And that, to some extent, justifies some of the seemingly irrational, but the move up in stock prices that we've seen since the election, which, as you know, has been pretty dramatic, but not entirely. In my judgment, the stock market itself, has more than discounted the numbers as I see it, and we're a little bit overvalued now. So, yes, it should go up as a reflection of the fact that corporate tax cuts may or probably will be coming. I assume no offsets, but corporate tax cuts will be coming. That will have an impact on S&P 500 operating earnings. But in my judgment, we've gone too far, too fast, and we're ahead of ourselves. We're overvalued currently.
Okay, ran too fast, too soon. I've got quick time to just get, closing comments from each one of you. And Seth, you go first. Let's talk about what you will be looking out for in Ms. Yellen's press conference, which starts in about 10 minutes from now.
Well, I'm curious to see if there's any comments about the real estate market here in the United States and the impact of rising interest rates. I think that, I believe strongly that the Fed will be looking at mortgage rates throughout the rest of the year. The impact of the rising rates hits borrowers directly. And we already have a situation where we've had prices on homes in particular are at pre-recession highs again in many areas. And higher rates will make it more difficult for people to borrow to buy homes. And so I think that's a major consideration. I would also be looking for comments about the impact of long-term rates on retirees. Retirees have been massively impacted the last 6 or 7 years. And I think that's going to be an area of focus.
Callum, what about you? The elephant in the room, Donald Trump, hasn't ever been spoken about. The Fed sort of so far has steered clear of that. Do you think she'll make an exception today?
I'm not sure she will, but what I'm looking for Yellen to highlight in particular is this encouraging soft data that we've seen in the US since the last set of forecasts in December. So soft data across the board has improved strongly, but what we've not seen yet is that catch up in the hard data. And it looks to me, looking at the Fed's forecast at least, like they're just focusing on the hard data, which is why we haven't seen the meaningful upward revision. So I'd just like to see the Fed's assessment of that return of bullish animal spirits, not just in the markets, but also in the real economy, just to see what the Fed thinks is behind that and just how sustainable it is and how long it would take, if those spirits were sustained, for we to see some improvement in the hard data that matches the pretty solid soft data that we've seen since the election.
Jay, Bryson, do you think another potential topic could be, the sharp drop that we've seen in oil prices? Would is it just sort of passing through? And do you think that's something that perhaps has the Fed a little worried?
Well, I don't think so. I mean, from what I understand, is a lot of the drop recently has been due more to there's a lot of drilling activity that's occurring here in the United States, and it's more of a supply sort of phenomenon than it is a demand. If anything, global demand is looking to be a little bit firmer right now. I think for me, the big thing that I would look for to see if there's any mention of is, was there any talk during the meeting of at what point do they stop reinvesting the proceeds of the bond purchases? That is, when a bond comes mature, now they go out and they buy another one, and then their next step into normalizing monetary policy is going to be to stop doing that, stop reinvesting those proceeds. And so, was there any talk about that? It wasn't mentioned in the statement, but that doesn't necessarily mean it wasn't talked about. And if there was some talk about that, I think you're going to see bond markets react to that as the Fed is not purchasing as many bonds.
Right. We let you have the last word. What should we be keeping our ears and eyes open for?
Thing that you want to keep your ears and eyes open for is whether there's any discussion by her about the equity markets and whether they are either at or bordering on becoming somewhat euphoric or irrational, to remind ourselves of Mr. Greenspan's comments. But I think I want to listen very carefully to what her assessment is of the current state of the equity markets, if indeed we're lucky enough to have her say anything. She does periodically say something about the condition of the equity markets, and will conclude that it's not irrational, or it's not speculative, or it's not overvalued. That's one thing I want to hear. One of your previous guests said, and I think it's important, as to the impact of rising interest rates on mortgage rates and both the residential and commercial housing component of the U.S. economy. That's going to be very important. And thirdly, what I really want to hear is if there's any comment at all about Trump's fiscal policy. I don't expect she'll say anything. I think she'll duck it. But nevertheless, it would be interesting to hear as to the extent to which the Trump fiscal policy is entering into the discussions, deliberations, and decisions of the Federal Reserve. That, to me, would be really very important.
Okay, we're still waiting, of course, for that press conference to start. And so, Seth, I'm going to throw it to you. What's expected tomorrow from Indian markets? Is it going to be business as usual? Since you're pretty convinced that almost after 8 years, markets will take in their stride what we see happen in the United States from the central bank?
I don't see any major event happening tomorrow. But I do see a continual gradual rise in the markets. What's going to really matter, as I always say, is earnings. And for some of the bigger IT companies, I do think there's some significant risk in regard to visa policy and availability of visas. But other than that, I think we're just going to see some continued success in the market for the next couple of weeks.
Callum, what's the outlook on the dollar. And, I'm asking this because there is a worry here that what could possibly play spoil sport for our India story is a higher and a stronger dollar. So far, we seem pretty resilient. But if you were to take, say, a 6-month view, where do you see the dollar headed?
On a trade-weighted basis, you could see the dollar up, say, a further 5-10%. That wouldn't surprise me at all. But what I would say is, when it comes to the relationship between emerging markets and the dollar, it's really important to pin down just what's driving the dollar appreciation. So let's say, cast our minds back to, say, Q3 2015, where markets were worried about the emerging market crisis or the fall in the price of oil, and we have this flight to safety. So that is all in all bad for emerging markets because it's a sign that global demand is weak. It's that markets don't have confidence about the outlook. So cash floods into places like the US and also into Europe, Japan as a safe haven. That, of course, is bad because any of those emerging markets that have dollar-denominated debt fall under pressure. Under circumstances which we're seeing now, dollar is appreciating on expectations of faster US growth. And with that stronger global growth, the US is the largest economy in the world still. Its households are the consumers of last resort. When you see stronger global growth, if it's accompanying the stronger dollar, that should be a positive for emerging markets. The export-oriented, mainly industrial producing emerging markets benefit from selling more of their wares abroad. So, of course, it still causes a few problems if you have debt denominated in dollars, but it depends really why the dollar is appreciating. Under these circumstances, I don't worry about EMs too much. If it was because global growth expectations were weak, then I'd be much more concerned about the emerging market outlook following the stronger dollar.
Right. All right, gentlemen, we'll leave it at that. Thank you, each one of you, for taking time out for us and joining in on this special edition. We'll say goodbye.
Find us on Facebook at facebook.com/etnow and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/etnow.